Did you know that QYLD, JEPQ, and QQQ, all three of these ETFs, are based on the same index, the Nasdaq 100? That's right. Companies like Apple, Microsoft, Nvidia, and Amazon, all included in the Nasdaq 100 index. But here's what's surprising. Even though they're all tied to the same index, the results you get from these ETFs can be completely different. In this video, I'll break down the key differences between these three ETFs, QYLD, JEPQ, and QQQ. Same index, but different strategies. And those strategies completely change your results. I'll also show you exactly how much you could expect in monthly dividend payouts if you invested $100,000 into each one. Let's get started. All three of these ETFs, QYLD, JEPQ, and QQQ, are built around the Nasdaq 100. This index includes 100 of the largest non-financial companies listed on the Nasdaq exchange. These are major tech companies: Apple, Microsoft, Amazon, Nvidia, Meta, Google, you name it. But here's the thing. While they all invest in the same index, these ETFs use very different strategies. And that strategy makes all the difference. Let's break them down one by one. First, QQQ. QQQ is the Invesco Nasdaq 100 ETF. It's one of the most popular ETFs for investors who want growth. This fund simply holds the Nasdaq 100 stocks and does nothing else. No option strategies, no covered calls, just straightforward stock ownership. If the market goes up, QQQ goes up. If the market drops, QQQ drops too. QQQ doesn't focus on dividends. In fact, the dividend yield on QQQ is usually pretty low, around 0.5% annually. So with $100,000 invested in QQQ, you'd get about $500 per year in dividends. That works out to less than $45 per month. QQQ's main goal is not to pay you monthly income. It's to grow your portfolio over time through capital appreciation. Now, let's talk about JEPQ. JEPQ is the JP Morgan Nasdaq Equity Premium Income ETF. Like QQQ, JEPQ also invests in companies from the Nasdaq 100. But JEPQ adds a covered call strategy to part of its holdings. This allows it to generate option income, which is paid out to investors as monthly dividends. Because of this approach, JEPQ provides more cash flow than QQQ, but it still holds on to some of the upside potential for growth. JEPQ typically yields around 11% annually. So with $100,000 invested in JEPQ, you could expect about $11,000 per year in dividends. That's around $900 per month. So right away you can see the difference. QQQ focuses on growth. JEPQ gives you growth plus steady monthly cash flow. Finally, let's look at QYLD. QYLD is the Global X Nasdaq 100 Covered Call ETF. This fund also holds Nasdaq 100 stocks. But here's the key difference. QYLD writes covered calls on 100% of its holdings. That means the fund is fully committed to generating option premiums every single month. The trade-off is that QYLD gives up most of its upside potential for stock growth. QYLD is all about maximizing monthly income. The yield on QYLD is usually around 12% annually, sometimes a little more depending on market conditions. So with $100,000 invested in QYLD, you could expect about $12,000 per year in dividends. That's about $1,000 per month in monthly payouts. But remember, QYLD focuses on income, not capital growth. Your principal may not grow much over time. In fact, the share price could go down depending on the market. So, let's compare the three side by side. With $100,000 invested, QQQ pays about $500 per year in dividends. That's less than $45 per month. JEPQ pays about $11,000 per year, or $900 per month. QYLD pays about $12,000 per year, or $1,000 per month. Same index, same group of companies, completely different results. Now, let's talk about why these results are so different. The key is the covered call strategy. Here's a quick breakdown of how it works. A covered call is when the fund sells a call option on a stock or index it already owns. The buyer of that option pays a premium for the right to buy the stock at a specific price. If the stock goes up past that price, the option buyer gets the gain. But the fund still keeps the premium. If the stock stays flat or drops, the option expires worthless, and the fund keeps the premium. For QYLD, the fund sells calls on all its holdings. For JEPQ, it sells calls on part of its holdings, leaving room for stock growth. For QQQ, there are no options at all, just pure growth investing. This strategy is what creates the difference between maximum income, balanced income, and growth-focused investing. Now, let's take it one step further and talk about volatility, or how much these funds swing up and down. QQQ tends to have the highest volatility, around 25% per year. JEPQ is a bit more stable, with volatility around 20%. QYLD is the most stable of the three, with volatility around 15%, since the option income helps smooth out the ride. So which one is right for you? Here's one way to think about it. If you're in your growth phase, you're still working, and you're not depending on your portfolio for income, then QQQ might be your best fit. It offers the highest long-term growth potential, even though it has the least cash flow. If you're preparing for retirement, or you've already retired but still want your principal to grow while receiving monthly income, JEPQ could be a good match. It gives you steady monthly dividends without giving up all of your upside. If you're already retired and your top priority is monthly cash flow, not growth, then QYLD might make sense. It focuses on maximizing income, even if that means limited capital appreciation. In other words, QQQ is for growth-focused investors. JEPQ is for those seeking a balance of income and growth. QYLD is for investors who prioritize steady monthly income. Same index, different strategies, different outcomes. So, which one fits your plan? If this video helped you better understand your options, be sure to like, subscribe, and turn on the notification bell. And let me know in the comments, are you focused on growth, balance, or income? This is expense-free fire, where we don't just wait decades for freedom. We build it one bill at a time. Thanks for listening, and I'll see you in the next one.